Hi guys, my name is Jay. If you don't know me, I am a Melbourne-based, Melbourne-raised father of two, entrepreneur, owner of a dance school called the Salsa Foundation with over 1,000 students a week, investor in residential property. I just wanted to make this video to introduce myself and document a new property journey for me. I'm starting to learn about investing into commercial property to generate some cash flow to eventually replace the income that I make from my business. And the reason why I'm doing this is because I feel it's important to start to pivot because I want to reinvest into my business. I initially got into negatively geared residential property as a way to offset some high income from the business. And so the negatively geared property allowed me to shelter some of that income from tax. But over the next couple of years, I want to reinvest it into the business expansion, which means that the profit margins on the business are going to shrink, which means that having a lot of negative geared property isn't going to make a lot of sense mathematically, financially, tax-wise, whatever you want to call it. Also, part of me wants to start setting up a replacement income for when I do eventually stop teaching and stop running this class. Maybe sell the business, run the business from behind the scenes while other people operate the business. So there's a couple of factors which have gone into doing this. Now, the first step that I've taken in looking into commercial property is to attend an educational seminar where they outlined the potential of commercial property. And I want to actually document this partially so that I can track my own progress down this journey, but also to share my journey with some of you guys who may be in the same position as me or a similar position and looking to get into it as well, just from a real live perspective of what's going through my head. Now, the first information session I attended was today, Saturday, the 28th of October, 2017. They explained a little bit about the structure of commercial property. And here's what I learned in the first session, which I'm going to sort of digest and think about along the way as I plan my strategy. Commercial property for creating a positive cash flow. The key points that I took away were that we'd be looking at a loan to value ratio of approximately 70%. 65 to 70%. Now you can go higher, up to 80% in some cases. And if we're doing through the self-managed super fund, which I set up with my mom and Diane and her mom, if we're doing through that, then I think there's other fees associated with this. But if we're looking at a loan of about 70%, which means a 30% deposit. So the case study we looked at was at a property which was $1,060,000 for the property. And when you add stamp duty and costs on top of that, I think they said it was about 0.5% of that, which is $53,000 in stamp duty and costs on top of the purchase price. So if we have $1,060,000 plus $53,000, the total purchase price is $1,113,000. Now, if you're getting a loan for 70%, you can't get a loan on the purchase costs and stamp duty. You can only get the loan on the value of the purchase price. So we said $1,113,000 was the total cost, but your loan you can only get on the $1,060,000 amount, which means the loan will be for $742,000. So $742,000 for the loan. That means you need to come up with, I think we said 1.113 million before. That means you need to come up with $371,000 to cover the purchase price, your deposit, plus purchasing costs, conveyancing, stamp duty, and all this kind of stuff. So $371,000 to get into $1 million commercial property. It's a lot of money. So they were suggesting people could do a combination of, if you have cash on hand, you can use that. Now, I don't have $371,000 cash on hand, unfortunately, to outright as a deposit, but they said you can do a combination of cash that you may have on hand and equity that you have in your property. Now, I have 4 residential properties. I'm not sure of what the equity is, so I'm going to have to look into the equity on that and see if that's something that we can unlock. Otherwise, maybe looking at getting into a smaller deal. But anyway, so they ran the numbers on this. If we're looking at $371,000 as your out-of-pocket costs to purchase it, including your deposit, and we are looking at the property being worth 1.06 million, then we are looking at a return. I think they said that the rent on the place was $86,000 a year. $86,000 a year. So $1.06 million property divided by 86,400, then we are looking at 86,400 divided by 1.06 million. We're looking at an 8.15% annual return. So the return on this one is 8.15%, which is really good return on the purchase price. Now, if you, for instance, if you have $371,000 was your out-of-pocket expense, the cash-on-cash return, meaning what you're making in your pocket as a percentage of what you initially invested to purchase the property out of your own pocket, then the percentage is 86,400 divided by $371,000 equals a 23.29% return cash on cash, which is really good. I mean, if you have $371,000 sitting in the bank, you're definitely not going to get 23.29% interest on that. So already it's looking like a really, really good idea. This is something that I want to start looking into a little bit more. I'm also looking at other investments, but this one's definitely catching my eye, and it's something that I'll continue to investigate, and I'm going to document it as we go, and I want to share with you guys the journey. So stay tuned for future editions of this journey.